Chapter, National Income and Accounting. So, in the last class, we have tried to understand basic terminologies of this chapter, that is the national income, regarding the definition, followed by the basic terminologies like the different types of goods, depreciation cost, stock and flow, and other concepts. And the last before video, in the recorded video, even we have discussed about three methods of measuring the national income. Okay, so in that method, we come across the three. First one is about which deals with the aggregate income method, and second one is about aggregate expenditure method, and third one is about product method. In such case, among the three methods, there are the different ways are there of measuring and expressing the national income. That the income can be expressed in many ways, and those expressing ways of national income, which is termed as macroeconomic identities. And these are the identities which helps us to understand overall financial performance of a country as well as a people of that country. Likewise, if a doctor want to diagnose a particular problem of a patient, then how will you want to see the pulse, the heartbeat, okay? And before coming to a particular conclusion, doctor want to identify the particular problem of the body of a particular patient. Likewise, if an economist, being an economist, if you wanted to analyze the performance of an overall country as well as the different economies in the world, then we have to understand some of the important macroeconomic identities. And those, not only the macroeconomic identities, which states about the pulse of the country, which states about the overall performance of a country, and which is also termed as identities are the elements, are the indicators of the country. Okay, they are the indicators of the country, and there are 8 to 9 macroeconomic identities are there, through which any of economists will come to a conclusion that what the country is and what the country can do and what the country is lagging and where the country wants to go. Okay, so because we all know that GDP is a first index which states about the welfare of the country. In such case, to understand not only the GDP, there are other economic identities are there through which we can understand overall performance of the country. So welcome to all of you. Let's begin with the macroeconomic identities. Macroeconomic identities. We can call it as indicators of the country. Now, there are 8 to 9 are there. Coming to one by one. First one is about, most of the people you might have heard about this thing, then that is called GDP. Then followed by many things are there. Next one is about NDP. Then third one GNP. Fourth one NNP. Fifth one PDI. Sixth one PCI. Seventh one PI, stands personal income. Then eighth one is about NNI, and the ninth one is about RNI. So coming to the all, these are all the just indicators of the country through which any of the economists, even a lay person, can understand what the country is and where the country is good and bad of it. So at present pandemic issue, if you wanted to judge any of a country's performance, we are not going to see the number of death rates or the birth rates and all. We are concerned with the welfare of the country as well as the overall financial performance of the country. Then that's the thing we used to call it as a economic situation. And that the economic situation generally used to take one word to express the level, then that is called a GDP. So before leading to the directly to all the points, let me explain all the expansion version of these acronyms. Coming to the first one, gross domestic product, followed by net domestic product, then gross national product, then net national product, personal disposable income, per capita income, personal income, net nominal income, and real national income. So these all the things are there. So where an economist need to understand. So being a commerce student, you need to understand, not only a commerce student, each and every layman must understand these elements because they are the indicators of the country. So knowingly or unknowingly, how your income, how your pocket controls the country, and how country policies controls your pocket, each and everything you will understand on these indicators. Now coming to the first one, GDP. GDP expanded as gross domestic product. GDP expanded as gross domestic product. What does this gross domestic product stands for? So first of all, GDP is a money value of all types of goods and services. It's a monetary value of all types of goods and services which have been produced in a country, which are accounted in a year. Then that is called gross domestic product. In simple, it's a monetary value of, or the money value of all. Here the goods and services refers to final goods and services. Regarding of it, which we have made already a discussion, what are the types of goods are there and what kind of goods we need to consider. Now coming to it, the money value or monetary value of all final goods and services produced in a country, okay, during a year. So we need to assess the entire performance of a country, not by one shot, like one day or 2 day or one particular sector and all. We have to take the monetary value because money is a measuring rod which measures the value of all final goods and services which have been produced in a country. Because as we are concerned with the domestic, here the domestic stands within a country. So which have been produced in a country means within a country in a year. Then the other thing we can express through the formula, because all the macroeconomic identities we have to express through the formula. Then the formula is very simple, which you people already come across under the expenditure method. Then that is called GDP equals to C plus I plus G plus net X. So where once again GDP equals to C plus I plus G plus net X. C stands here consumption expenditure. Consumption expenditure done by the people of the country, or in simple we can call it as a households of the country, because households are the owners of the factors of production. Then they are the receiving point of income generated by the farm sector. Then these household, whatever they want to spend the money for the different purposes, then that is the first element which have been taken to assess the aggregate expenditure in a country. Then that is the GDP. Then that is about consumption expenditure done by the people of the country. Coming to the I, then that is called investment expenditure. Investment expenditure done by the people of the country. We not only spend our money for a consumption purpose, even we spend our earnings on a different investment purpose, like investment on vehicle, investment on gold, investment on securities, investments on our education sometimes, okay, investment on different accessories, investments on buildings, investments on land. Likewise, we do our investments for the future benefit on different purposes. Then that is another part of an expenditure. Coming to the third one, then that is called G. G stands here government consumption as well as an expenditure. So not only the people of the country will spend the money, even government does the same of running up of the public sector. Like in order to run a public sector like public company, public factories, public utility services, okay, for all this even the government requires money. Then that the whatever the money they want to spend for running up of the public sector as well as investment done by the public sector, like investment on railways, investments on road, bridge, dams, schools, college, hospitals, infrastructure, everything, then this all comes under a government expenditure and even government investments. Then that is called G. Then last one is about net X. X stands here exports. Exports expenditure. Even if people are already come across it in a first PU, where which stands that an external affair. External affair in the sense a country's international trade, where it deals with the exports and imports as well as the interport. So when the goods have been made of 100% quality, they are subjected to export from our country to the rest of the world. Then whatever the amount of expenditure which is connected with the exports of those goods and running around of different services at the worldwide, then this all comes under a net X, stands here exports minus imports. In simple, we can put it as a exports expenditure or expenditure in connection with the exports. If you add up all these three plus this one, then there is an actual the monetary value of final goods and services which have been produced within country, then that is called domestic. Within a country in a year, then that is called GDP. Then if this is the GDP, then you people need to understand then how the net domestic product can be calculated. So coming to this one, formula is very simple. GDP equals to C plus I plus G plus net X. We are going to aggregate consumption expenditure. Now coming to the next one, the next macroeconomic indicator, then that is called NDP. NDP stands net domestic product. Net domestic product. In order to arrive the net output of the country's production of final goods and services, we need to calculate a bit more elaborated version of the country's output, then that is called NDP, net domestic product. Then the formula is very simple of calculation of NDP. So NDP equals to C plus I plus G plus X minus M minus DC. Here the DC stands depreciation cost. Everything will be similar like C plus I plus G, as well as X minus M stands for exports minus imports, and minus DC. DC is about depreciation cost. So here the DC, the depreciation cost, it is to be considered to arrive a net output of the country, because a depreciation cost which has been set aside to meet the same asset in the future, which we have already discussed. So most of the students have been already answered regarding a DC. Depreciation cost is not an actual outflow of cash, it's an amount which is just kept aside to meet the same asset for the replacement as well as repairs in the future. So in order to see the net output of the country, net output of final goods and services which have been produced within a country, then one has to go by net domestic product, then that is called NDP. And the formula is very simple, C plus I plus G plus X minus M minus DC. Or else we can go by another formula of expressing NDP, then that is called NDP equals to GDP minus DC. So this is a simplified formula of calculating of a net domestic product. So this is only a version which states about whatever the output have been produced, the final goods and services. The final goods which we have taken because it includes all types of intermediate goods. So the value of final goods and services which have been produced within a country. Then if you wanted to go by the bit more elaborated version of understanding the country's financial performance, then we have to go by third indicator, third macroeconomic indicator. Then that is called the third one, GNP. Here the GNP stands gross national product. Gross national product. So far we have discussed the two things. First one is called GDP, then NDP. Now the third one is about not GDP, it's about GNP, gross national product. So what makes so difference between GNP and GDP? GDP, it's a monetary value of final goods and services which have been produced within the country. But here we are not concerned with only the monetary value of final goods and services within country, even we have considered income from abroad, because a country cannot only and solely depend upon the country itself. Any country cannot be called as a closed economy. It has to depend some other in some other way in different countries. So it deals with the exports as well as the imports, as well as the receipts and the payments. Regarding of it, we will discuss today's topic once again, the gross national product. Gross national product is a money value or monetary value of all final goods and services produced within a country, even income from abroad. Then that's the thing we can easily, even income from abroad. Then that's the thing we can express in a formula wise. Then the formula is very simple. GNP, gross national product, equals to C plus I plus G plus X minus M, exports minus imports, plus R minus P. Here everything is simple and same up to C plus I plus G, even X minus M, and we are concerned with the R minus P now. R stands here receipts, which have been done by the nationals or non-residents of India who are working in foreign, but they are paying taxes here. Then that is called receipts. And P stands payment made to local foreigners. In simple, R stands receipts made by nationals of the country. Nationals of the country. In simple, assume you have some friends who are Indians, who are working in somewhere abroad, but in a year they are visiting their motherland, and according to the income tax rules, they are paying some sort of a tax to the Indian government. Then another point is called receipts, which is done by the India from the nationals who are staying in foreign. Then that is called receipt. And P stands here payments. Payments which is made by the government of India to the local foreigners. Like our people will work in somewhere and they are earning over there and they are paying taxes here according to the as a non-resident of India income tax rule. So there are the three stages of a person. One is called resident, next one is called not ordinary resident, and the third one is about non-resident. So coming to the first and the second, they are liable to the taxes in India regarding the income tax rules of some of the number of days in 7 years or 10 years. Some rules are there. According to they have to pay the tax. Then that is an income which acts as a receipt of the country. And here are the payments which is made to local foreigners. Local foreigners who are staying in India. Then that is called payments. In Ballari, you cannot see the number of foreigners. If you go by the metropolitan cities like Bangalore, Mumbai, Delhi and all, so you will find n number of foreigners who are working in India. So they have a headquarters in somewhere other than India, but they are still working in India, and here they have been paid as a paid laborers or paid employees. Then that is called local payments to the foreigners. Then that should be deducted. Then through which we can call it as a income from abroad. You take any of an industrialist who is situated their entire business entity here, and he has expanded their business branches in somewhere other than India. At the same time, he is working in somewhere and earning over there. According to the income tax slab, if he is able to pay the tax to India, then that is called receipt of the country, which is done by the nationals. Okay, and at the same time, some of the foreigners, they have expanded their business operations and they have situated there some of the branches in India, and the foreigners who are working here, earning here, and they are paying somewhere taxes, and moreover here the payments have been made. Then that is called local foreigners, which is made a payment made by India. So this should be considered to arrive the net income of a means the national income of a country. Then that is called gross national product. In simple, gross national product which states about the monetary value of all final goods and services which have been produced in a country, even income from abroad, because India is not that kind of a country which never depends upon some other. Even most of the foreigners depend here to do their trade activities, and we depend upon some of the most of the commercial and other activities for some other country. So we are concerned with the number of receipts and payments. And moreover, if receipts are good, then they will be under the surplus balance of payment. If our payments are more, then we will be under the deficit balance of payment. Regarding of it, we will discuss in the last chapter of macroeconomics regarding how the international balance of payment will work with the deficit and the surplus payments. So regarding of it, formula is very simple. GNP is the monetary value of all final goods and services which have been produced in a country, as well as income earned from abroad. Then that is called consumption expenditure, investment expenditure, government consumption and expenditure, as well as export expenditure, as well as the receipts and minus payments. And this is a guaranteed question which have been raised number of times in your exams, as well as in future competitive exams too, regarding how do you calculate the point called GNP. After this, we are entering to the next level of analyzing the level of national output or financial performance of the country. Then that is called NNP, stands net national product. Net national product. It's very simple, because whatever the C and I and G concerned with that, we are using directly or indirectly capital goods. Here the capital goods refers to assets of the country, which includes road, bridge, dam, school, college, hospitals, universities, okay, infrastructure, okay, in general. And whatever we are using these assets, they are subjected to certain amount of depreciation. When we are using different types of these assets, they are subjected to somewhere it requires repairs and renewals. To assess the net figure of the country at the national level, we need to calculate the net national product. Then the formula is very simple. That is NNP, net national product, equals to, its elaborate formula is there. We have a two way of expression of this formula. Then first one is about C plus I plus G plus X minus M plus R minus P minus DC. DC again stands for depreciation cost. To go for the receipts as well as the payments, to go for the exports as well as the imports, we are concerned with the different types of capital goods. And these capital goods requires in the short term, either in long term, some kind of a replacement as well as repairs. Then the charge should be deducted from the country's final output, so that we can arrive the final level of net output of country's financial performance. Then that is called net national product. Else we can go by the next version or the next formula, or simple formula of calculating NNP. Then that is about NNP equals to GNP minus DC. Again, DC stands for depreciation cost. So either we can go by this elaborated formula to calculate the point of NNP, or else we can go by GNP minus DC. I want you to note down this formula when I supply concern the notes part of it. Okay, so we will discuss much more regarding how national financial performance can be calculated. So this is a formula which is used to calculate GNP. If these are the four important macro economic identities, after this, next one is that the point which we used to discuss, then that is called personal disposable income. Then that is called PDI. Before leading into the PDI, let me tell you, there are different two types of categories will come out of the earnings. That is called income. Because whatever an individual will earn the income, then that the income is classified under two heads. One is called discretionary income. Second one is called disposable income. For example, the income when a particular person earns, out of the earning, then he has to make certain expenses where he cannot make a compensation with the some other expenses. So he cannot compromise with the certain elements like house rent, like ration, like day-to-day expenses, or some of the standard recurring monthly expenses. Then that the point is called discretionary income. After paying all these, whatever the rest amount lies in his hand, then that is called a disposable income. For example, assume an ex-person who has earned some 10,000. Out of the 10,000, if he makes 7,000, which is guaranteed, compulsory, mandatory to meet the day-to-day expenses and monthly expenses, including education, government taxes, and even the house rent expenses and ration and some of the medical expenses and all, around some 7,000 is there. And remaining the 3,000, what it lies in his hand, then that is called a disposable income. Then that the disposable income of a person, of every individual, he can dispose on any of which he needs, which he wishes. Then that is called personal disposable income. In simple, personal disposable income is that kind of an income where a person can dispose according to his needs and wishes. If that is the case, then how this thing can be calculated in a sense? PDI, personal disposable income can be calculated as PDI equals to PI minus taxes. Whatever the earnings which is done by the people, the personal income. From that personal income, he has to pay a taxes. Then only it will be known as a valid income. We can, of course, we are discussing about the valid money, the white income. Okay, then that is called a real income. Okay, if you didn't pay the tax, then that will be known as a black money. If you pay the tax, then that will be known as a white money, where we can expend for the different purposes. Then that is called personal disposable income. Okay, so regarding of this thing, we'll discuss much more in the next further classes. So, and I want you to be attend for the next coming all online classes, because